Good afternoon. We appreciate your patience. We had a few people that were coming in a little late, and we wanted everybody to be able to hear the good news that we have to spread today. This is Pastor Mark. Just kidding. Today we're going to discuss a very exciting option. It's understanding the dental vision HCSO HRA in 2014. Before we get started, let's introduce you to the Beneflex members here today. I'm Mark Smerschel. I'm the Vice President of Beneflex, and I'm FCS certified. This is a certification in flexible compensation pre-tax benefits provided by the ECFC, which is the Employers Council on Flexible Compensation. Beneflex has been an active member and a longtime supporter of the ECFC. It's an organization dedicated to the advocacy, education, advancement, and innovation of tax-advantaged benefit programs that facilitate choice for employers and their employees. One of the roles of the ECFC is to certify TPAs, so there's an advanced level of knowledge and professionalism in the services we provide. Beneflex is very dedicated to the advancement of TPA and employer pre-tax benefit education, and recently the ECFC board presented me the honor of electing me to their board of directors. Beneflex is going to have a larger presence at the ECFC, and we see that as a win-win for our clients, for your employees, and our staff. Now this just happened, so I'm waiting to see if it's an honor or a sentence to 3 years of hard manual labor discussing discrimination testing. Yuck. All right, so joining me today is Brenda Cox, our operations manager. Brenda is certified in flexible compensation. This is an additional level of education and certification by the ECFC. The ECFC certification Brenda has is sort of a compliance driver for TPAs, and there aren't many of them around, so we're pretty proud of Brenda. For today's presentation, let me remind you, you're going to be in listen-only mode. If you have any questions, please type them in and we'll answer them at the end of the presentation as time permits. If you registered for the webinar prior to today, you should have received a copy of the PowerPoint presentation. At the end of the presentation, we will list where you can review a copy of the PowerPoint presentation, and if you want to punish yourself, you can listen to me in a recording again of the whole webinar. So, today's agenda. It was built, let me tell you, after many hours with our compliance team, our benefits attorney, and an unending string of emails to the San Francisco HCSO Office of Labor Standards Enforcement. We are going to talk about and review healthcare reform changes to the HCSO and HRAs in 2014. We're going to highlight recent FAQs released by the city regarding HCSO HRAs. We're going to discuss how Beneflex will help you to remain compliant and your go-forward options for 2014. Beneflex services, I always like to touch base on those because your needs are always changing. And you'll see the first thing we list are the health reimbursement arrangements, the HRAs and limited HRAs. I want to point out that Beneflex has been doing limited HRAs, which include dental vision HRAs, for a long time. This makes us very comfortable with the new San Francisco HCSO dental vision HRA. Now, we've already discussed the HCO spend down in a previous webinar we did, but we're going to touch on it again because we want you to feel comfortable how it's going to work hand in hand with the new limited scope dental vision HRA. For our benefit clients, we have done and continue to do many new exchange notice services due to the ACA ruling. These notices are all done hand in hand with our existing services, the flexible spending accounts, the limited flexible spending account, health savings accounts partnered with our smart card. And if you don't have a smart card for your HSAs, you need to give us a call and talk about them. We continue to do a lot of premium-only plans, which is a good sign. That means the economy is growing and new businesses are starting up. Due to the San Francisco ordinance, we do a lot of the transportation management accounts. We perform COBRA HIPAA administration for many of you, which has all of the needed language that has been added due to the exchange notices which were created due to healthcare reform. So let's quickly review the impact of healthcare reform. Starting with POP, employers lost the ability to let their employees pay for individual health insurance premiums pre-tax. This was put in place because the government didn't want to let employees go out to the exchange websites, which are discounted, and have supplements, and to be able to pay for their portion with pre-taxed dollars. So the premium-only plan, the POP has lost the ability to do that, and also the FSA, which also had the ability to allow employees to pay individual health insurance premiums pre-tax. That has also been stopped. Now in place, the FSA $2,500 cap for medical. That's been in place now we're on our second year. This will be our third year, I'm sorry. To be in an FSA, employees must be eligible for their employer's health insurance plan. That's new in 2014. We have a lot of employers that this was something that caught them off guard because they had part-time employees that weren't eligible for their health insurance in the FSA. So they had to be removed from those plans. We now, we trick-or-treat on Halloween, October 31st, the $500 carryover option was announced. If you do that option, you can not have the grace period. We did a webinar on the $500 medical carryover. It is also posted on our website. If you're looking for some entertainment during lunch, you might want to listen to that sometime and see what your options are, or give us a call. We'd be glad to talk through how the program would work for you. And another big surprise that came out at the same time as the carryover is employers are capped on their FSA contributions. Used to be employers could put in as much as they wanted, and employer contributions for the medical FSA are now capped at $500. Dependent care has no contribution limit up to the $5,000 amount. Now that is the total amount that can be done, whereas the $500 employer contribution for the FSA is in addition to the employee's $2,500 cap. So those are a lot of things that the FSA had happened to it with healthcare reform. Rolling into COBRA, of course, I mentioned the exchange notice obligations. We have many employers that are notifying Beneflex within 3 days after they hire someone so that Beneflex can get the new hire notice language out to them regarding the exchanges within 2 weeks after being hired. That's a requirement by the government. And of course, all of our COBRA notices have the language added to them regarding the exchange notices, so they're all compliant. And finally, the reason we're here today is to talk about HRAs. Healthcare reform had a great impact on the standalone HRAs. We also lost the ability to pay individual health insurance premiums pre-tax in the HRA as we did with the POP and FSA. So there's been a lot of changes, and everybody's scrambling and getting this information about the HCSO this late in the game makes this difficult, but it is something that we can all handle. So with the San Francisco HCSO HRA in 2007, you had 3 options to be compliant with the ordinance. You could do insurance, you could do your standalone HRA, which was executed by Beneflex, and that was a great program. A lot of money was saved because it was a promise to pay plan. And then you had the city option. Well, IRS Notice 2013-54 put the final nail in the coffin, so to speak, on the HRAs, because the guidance foreclosed the ability of employers to offer standalone HRAs, standalone MERPs, and limited dollar HRAs. But most importantly, it closed down the HCSO HRAs that we were doing for San Francisco, beginning with new plan years on or after January 1, 2014. Now, the recent FAQs have impacted that HRA option, and that's what we're here to talk about. But 2013-54 stopped your current HCSOs that reimbursed all the medical 213D expenses. So recently published on December 24th in the edition of the Federal Register, IRS Notice 2013-3553, agencies propose important changes to accepted benefits under HIPAA and healthcare reform. Those were changes to the Employee Assistance Program and dental and vision benefits. Now, we're going to talk about those, but I do want to mention in the headline here, propose important changes. According to the EBIA, and we follow the EBIA very closely, that's the Employee Benefit Institute of America, it says propose, but the new exception for EAPs and the changes to the dental, vision, and long-term care exceptions are so straightforward. In fact, they're straightforward enough. EBIA says they can be relied on now until final regs are published. So in talking about the EAP and the dental vision benefits, we need to first touch base on accepted benefits. The IRS, DOL, and HHS have issued proposed regulations that would add 2 new types of accepted benefits and remove one condition for self-insured dental, vision, or long-term care coverage to be treated as accepted benefits under HIPAA and healthcare reform. This has important implications for employers and employees. As background, this is important, accepted benefits are exempt from certain mandates applicable to group health plans under HIPAA and healthcare reform. However, an employer cannot reduce or avoid potential employer shared responsibility penalties by providing these accepted benefits. From the employee's perspective, accepted benefit coverage doesn't satisfy individual coverage mandates. But the important thing that this does, it allows that if you're electing such coverage and you're going to do these accepted benefits for dental, vision, and long-term care, by electing this coverage, it does not disqualify them from eligibility for premium tax credits for coverage purchased through an exchange. And that's the whole reason that this was put in place. We want to let employees get to the exchange, and the government wants to let them get the premium tax credits if they're eligible. So in talking about this a little further, I just want to touch on the EAPs, but that's not the main focus of our discussion. But since it was part of the Notice 2013-3553, I just want to say that the EAPs, the following conditions were added. EAP benefits cannot be coordinated with benefits under another group plan. The EAP cannot be a gatekeeper. EAP eligibility cannot be dependent on participation in another group plan, and no employee contributions can be required as a condition of participation in the EAP. Now, a lot of you out there might be saying, EAP, I don't know what you're talking about, Mark, and that's fine. But for those of you that are familiar with the EAP, this was also good news because this proposal made it so that you would not need to offer an opt-out or waiver if employees wanted to seek exchange coverage on the at California Insurance Exchange. So I just want to mention that because that does tie in. It is another accepted benefit, but we're not here to talk about EAPs. We're here to talk about dental and vision accepted benefits. And currently, self-insured dental, vision, or long-term care coverage is an accepted benefit if employees can elect not to receive the coverage, and those electing coverage may pay an additional contribution. The proposed regulations would maintain the separate election, and that's when we're going to talk about the waiver a little later on, but it eliminates the additional contribution requirement. Now, honestly, the separate contribution condition has been long viewed as a formality. The cost of collecting that participant's contribution, no matter how small, a lot of times costs more than the contribution itself. So this is a welcome change in the rules and resolving some uncertainty regarding HRA's structure to provide only accepted benefits such as limited scope, vision, and dental coverage. Now why is this so important for HCSO? And we're going to roll into the HCSO now because it's important, because by allowing this dental vision as an accepted benefit, and we're going to talk about what the FAQs have to say about accepted benefits. So if you visit the HCFO and the Affordable Care Act FAQs, and this is their home website page, the direct address to get to those FAQs, or you can go to HCFO's homepage and get to the FAQs from there. But here's the direct connection. This website, and it's important to say, on December 20th, the City of San Francisco released guidance authorizing employers to satisfy the San Francisco Healthcare Security Ordinance spending requirement by using health reimbursement arrangement, HRAs, that are limited to specified benefits accepted from the Affordable Care Act. And that's why we just spent the last 5 minutes talking about accepted benefits, because that action that the IRS Notice 2013-3553 did set up the city to publish these FAQs that are going to allow us to present another option for you to be in compliance with HCSO. Now, this is our second webinar regarding the FAQs, and it's interesting, if you go to the home page, it says answers are subject to change as new information or guidance becomes available. All I can say is we hope so, because there's a little unclarity in these FAQs, and we're going to discuss those today. But, all I can say to the city is please hurry up, because we need that additional guidance. So FAQs on accepted benefits. If you were to have these up, and I'm not going to read everything, but it's important that I use some of their language so that you're comfortable with what it says. But as we discussed, accepted benefits is a term used in the Affordable Care Act to describe certain kinds of health benefits that are accepted from some of the market reform requirements that the ACA requires other group health plans to meet. Accepted benefits, as I said, are not minimal essential coverage. And the more important thing, they do not affect an employee's eligibility to receive a premium assistant tax credit. That is the big thing for the government. They want you available for that tax credit when you're buying insurance on Covered California. Employers can provide accepted benefits whether or not they're also providing health insurance. The Internal Revenue Service code and its accompanying regulations contain the full list of accepted benefits and place some limits on how they can be offered. But only some of those accepted benefits also qualify as health care services under the HCSO. And those benefits are dental benefits, limited treatment of the mouth; vision benefits, limited treatment of the eye; medical indemnity insurance; long-term nursing home health or community-based care; and coverage limited to a specific disease or illness. Now, employers can provide accepted benefits to employees directly through insurance or by providing health reimbursement arrangements, HRAs. And I want to call attention before we leave this slide, because we're going to talk about this quite a bit, to medical indemnity insurance and to the other accepted benefit, coverage limited to a specific disease or illness. A question submitted by Beneflex to the HCSO Office of Compliance regarding those two accepted benefits, medical indemnity insurance and coverage limited to a specific disease or illness. Both of those are not reimbursable under an HRA per current federal regulations. So, why is this important? Well, if you look at the next slide, you're going to see that FAQ 4F says, how will OSE determine whether a contribution to an accepted benefit HRA is reasonably calculated to benefit the employees? You're going to see a reasonably calculated everywhere in these FAQs. That's always been out there as a strong, important approach to the HCSO by OLSE. OLSE considers an employer's contributions to an accepted benefits HRA that do not exceed the employer's spending requirement for an employee who works, now this is the important part, an average of 20 hours per week, to be reasonably calculated to benefit the employee, provided that the contribution meets all of the following criteria. And the following criteria must be met by the employer. One, the contributions must be used without restriction for full reimbursement of all, underline the word all, accepted benefits that are also qualifying health care expenditures under HCSO. For a list of those expenditures, and we just showed you that a couple slides back at those 5 accepted benefits. 2, the employer has at least a 90-day grace period after the contribution expires to submit claims for reimbursable expenses that the employee incurred before the contribution expired. And 3, the criteria listed in 1 and 2 are in place at the beginning of the initial plan year or on April 1st, 2014, whichever is later. Now, at least number 3 is good news. They're giving you some time. But number 1 is a problem. And we've reached out to the city for clarification because they're saying they want all of those benefits offered in a accepted benefit HRA, dental, vision, and et cetera, but the HRA can't do the 2 points that I talked about. They can't do the benefits that are all listed because the government, the HRA doesn't allow it. So that question is hanging over our head. Now, on number 2, that's also good news because we already administer our HCSO HRA plans with a 90-day grace period. And it's not all that the city is asking for because, and it's not all that we're doing, because the city also wants there to be employer contributions that are accepted to HRA benefits for the HRA counts. And that is listed here as if they are, one, you must have contributions that are reasonably calculated. Two, the funds remain available to the employee for 24 months after the date of the contribution. Three, employers provide the employees with written notice of the contribution within 50 days. Those are our quarterly statements that Beneflix is doing for you every quarter. And four, the employer meets additional requirements regarding separation of employees. And those are our termination statements. All four of these are repeats of the guidelines on how Beneflix has been administering your HRA for the HCSO anyway. So, you know, this FAQ 4E is not a problem also. So we're feeling good about both of these, a lot of these guidelines. So let's have a little discussion about parts of this FAQ, because I said the reason we calculated, and I also emphasized the average of 20 hours per week. 4G on the FAQs, what is my company's accepted benefit HRA plan? What if my company's accepted benefits HRA plan does not meet the criteria, or I make contributions in excess of my employer's spending requirements for a 20-hour per week employee? Will OLSE still count my contributions towards satisfying my employer's spending requirement? Now, this is a long answer, and I'm not going to go through all of it, but the meat of the answer is to receive credit for contributions to an accepted benefit HRA that does not meet the criteria. The employer must request credit at the end of the calendar year and provide supporting documentation showing that its contributions were reasonably calculated to benefit the employee. OLSE will presume that contributions were reasonably calculated to benefit the employee if the reimbursement rate for the plan meets or exceeds the average reimbursement rate for accepted benefit HRAs that do not comply with the criteria. Remember the criteria? 1, all accepted benefits. 2, 90-day grace period. 3, plan in place by April 1 of 2014 at the latest. So that talks about reasonably calculated. What about the average 20 hours per week? Well, employers' contributions to an accepted benefits HRA that meet the criteria in FAQ 4F but exceed the employer's spending requirement for an employee working an average of 20 hours a week. Excess contributions will be credited towards the employer's spending requirement in the amount that the employee actually uses the excessive contribution. Say what? An employer, I tried to break this down into some English. So to repeat, hopefully in English, an employer can use a limited scope HRA to meet their HCSO obligations if it's reasonably calculated. That means if it includes all accepted benefits. We've petitioned the city a couple of times now for clarification on the 2 HRA accepted benefits that we cannot do. We feel, my crystal ball and I, and let me underline I'm using the crystal ball for this answer, we feel that the city has got to go with the dental, vision, and long-term care that the HRA can offer and do. It's still up in the air. In talking with the manager, they said that they would consider plans that offered that to be compliant because they don't have the guidance out. And I'm going to talk about that in a minute because it's frustrating when they want you to have these plans operating but the guidance not out. So the limited scope HRA, in our mind, for dental, vision, and long-term care is reasonably calculated to benefit the employees. I know we're all going to wait for the city to confirm that, but that's what I have a lot of employers moving forward with. And reasonably calculated is all employees who work 8 to 20 hours a week on the average. So I called the city for clarification, and as I said, they had none, because when we read that stipulation, we were confused that are they giving us just an example of 20 hours a week, or are they saying that's what they consider to be reasonably calculated? And I have to give Brenda credit for that, because she's the one who was concerned that it wasn't an example, but it was their understanding. And the city did clarify that is their understanding. They will allow you to do the dental vision long-term care HRA, but it's for employees that work from 8 to 20 hours a week on average. Now, there's 13 weeks in a quarter, so you would look at your 13-week total and divide that by 13 weeks to come up with your average. So there's a lot of participants that fall into that category. So that's good news for a lot of you out there. It's going to allow you to save a lot of money, because the HRA has proven itself with the HCSO to be a vehicle that only has 20 to 25% usage. So if the funds aren't used, they're going to revert back to the employers. The employees' medical expenses are taken care of, and it's going to be for dental and vision and long-term care. So this is good news. Now, the bad news is we're waiting for the city to tell us exactly how they're going to calculate what they consider reasonably calculated expenses for that 21 to 40 hour group. Now, in talking to the manager with HCSO, they had said that they had participated in 2 separate discussions. And again, these are not the official FAQ guidelines, but the 2 discussions this manager had participated in was, one, they were thinking that for the 21 to 40 hour average employee, that you would match the spending percentage of the reasonably calculated 8 to 20. So if your 8 to 20 hour employees are using 15% of the funds that are in their HRA, which is great for you, then they would want that employee with the 21 to 40 to use 15% of the total amount. Now, that's not terrible, but I tried to explain to the manager that medical expenses are dictated by medical needs, not by availability of funds. And she made note of that. She said the other discussion they had, and this one was a little more upsetting, was that you had to have 100% of expenditure for all dollars in that 21 to 40 hour range, meaning you could have employees in the 8 to 20 that would use 15 to 20%, but if that employee worked anything from 21 to 40 and you put them in the HRA, they wanted 100% of that money spent somehow. Now, going to the next slide, it's kind of interesting that they would give that answer as a possible option, because when you look at these employees that have an average of 21 to 40, it seems to me you've got 3 options. The city option, and they keep 100% of the funds, which is why it was interesting, that's not used, which is why it was interesting that that was their second option in discussion. You have the insurance option for employees that work 21 to 40 hours a week, or the Boone Group, which you would do through your broker, and we talked about that on a previous webinar. Or you've got an option, if you have an employee that works 40 hours a week, you could use Beneflex's HCSO Dental Vision HRA for up to 20 hours, put them in an HRA, and the other 21 to 40 hours could go in the city option. So that's why we have so many employers that are excited. This is our second webinar on this. They've got a chance to continue to save some of that money. So there's 3 options out there. Now, as I mentioned, we did an FAQ presentation in November, and we on the first 2 FAQs that came out, and at that same time, we also presented the Boone Group as an option. And then to refresh your memory, we did a slide on the Boone Group versus the city. If you want to do 100%, you know, all my people are 40 hours, they don't have benefits, I don't want to deal with 2 plans, so I don't want to do the dental vision HRA, I'm going to either do the Boone Group or the city option. Remember that in doing the presentation, we kind of felt that the Boone Group was a better option because it had better benefits for the same cost. They both cost 100% of the funds. The city option, though, does not have a PPO network. So if you go to the doctor, you could have a $200 visit with RX of $50. I hope it's 50, and a hospital stay of $4,000. If you take those same expenses through the Boone Group, that doctor visit goes down from $200 to $50, and the RX might go down from $50 to $10. Transamerica pays $3,100 for that first night's visit, night misspelled on my notes, not on the slide, thank you. That $3,100 is paid to you. So that's good news for you if you want to use the Boone Group. Again, it's another option. The Boone Group has said they will do a split plan, meaning if you have employers that you want to put in Beneflex's HRA, you'd give me all the 20-hour employees because you're going to save money on those, but you're still meeting the spend requirement. They have a benefit. And any employees that work more than 20 hours, you would put that full employee in the Boone plan. So that's another option. So we're pretty excited about that. So if you take the Beneflex HCSO Dental Vision HRA and compare it to the city option, the employers are still going to hold the HRA funds in the Beneflex plan. Remember, the city holds all the funds and they want those funds on the first day. Second, HRA funds are only used to reimburse actual expenses for dental and vision. The city is going to reimburse all medical 213 expenses, and if it's not used, they're going to keep it. The city is not changing their medical reimbursement plan to dental vision HRA because they say they're not an HRA. They don't have to do that. Unused HRA funds with Beneflex's dental vision HRA are returned after 24 months. City keeps 100%. And the other thing that I think is a very positive thing for the Beneflex dental vision HRA, it's very similar to your other HRA. They're still working with Beneflex. They're still getting weekly reimbursements. Your employees know how the plan works. It's just the benefits are going to have to change. And the good news is the employers are still going to get those same savings they've been getting, and they might even get greater savings. A reoccurring question from our Beneflex clients, and excuse me as I take a drink of water, what about my existing HCSO HRA? According to the ordinance FAQs, the 24-month spend down is still in place. You must continue to meet ordinance requirements, and you have to keep sending out those notifications, and you have to keep the records for all of those mailings. So nothing's going to change with your HCSO HRA 24-month spend down, except we need to talk about the dental vision, because the rundown for the current HCSO HRA for 24 months, now I'm not talking about the new thing coming up for 2014, this is the rundown of your current plan. You remember, you're going to have those fourth quarter contributions from 2013. Ordinance says those funds have to be available for 24 months. Beneflex is administering that 24-month spend down, so you're going to be compliant with everything they say, and during that rundown, we're keeping everything in place. The customer service is going to be in English and Spanish. The documents, the forms you receive, you can choose English and Spanish. But going forward, we need to talk about Beneflex's dental vision for 2014. That's the new benefit, the accepted benefit, and also the current HCSO HRA for 24 months, because those are going to be happening concurrently for everyone that chooses to stay with us for those new 2014 rewards. So both of those plans that Beneflex is going to administer is going to require plan docs. Beneflex has always done those for you and will continue to do those for you. Both of those plans are going to require summary plan descriptions. Your SPDs will be sent, as they've always been sent by Beneflex, proof of delivery. The summary of benefits coverage as required by the DOL. Both plans are going to require that. Beneflex takes care of that for you. The HCSO quarterly statements don't go away. Both plans require that. Beneflex will do both. Termination statements as required by HCSO will go out as they always have. And as I mentioned, all sent proof of delivery by Beneflex, because that's the way the city says it has to be done. Now, I do want to take a second and talk about the HCSO HRA rundown for the 24-month plan. Okay? Because on December 31, which is already passed, that's the date we're putting on the fourth quarter rewards for 2013. So even though you're sending me your fourth quarter rewards on January the 15th for a guaranteed delivery date of March 30th. Now, some of you understand we work with anything that comes in after that, and we rush to get it out by January 30th, but the guarantee for it to be out January 30th is January 15th. So the due date for your fourth quarter 2013 is January 15th. It's always been the 15th of the month following the rewards. The fourth quarter statements will be sent on January 30th, and for the 24-month rundown, Beneflex is going to continue to send out those quarterly statements the way we always have. Now, the Beneflex HCSO HRA rundown timeline, again, remember, only 24-month people. If you're not going to do the new 24 accepted benefit dental vision HRA, I know this has to be rough for you guys to understand, because it's rough for me to say. The last day to submit HCSO HRA rundown claims, rundown only, will be December 31st, 2015. Let's say you decided to go with the Boone Group 100% and Beneflex is only doing your rundown. We need to make sure that you're aware, your employees are aware, 12/31/15 is the last date to submit claims, and there would normally be a quarterly report, but since the plan closes at that point, there'll be no more quarterly reports going forward. So some of the questions that we've received, and I tried to be proactive to put them in the PowerPoint presentation so that you had a copy of them. Do I switch to the new dental vision HRA for both HRA plans? You know, can I do that? When can I do that? Well, let's look at the new limited scope dental vision HRA versus the current HCSO HR spend down. The rundown and the new dental vision HRA are going to both meet HCSO HRA obligations. The rundown is allowed. Only the new dental vision HRA does not risk exchange subsidies for your employees. That is key. Does not risk the exchange subsidy. If your employees want that, they have to be allowed to get it. The new dental vision HRA is easier for employees to have one plan. They're working with Beneflex. They have one plan to try and keep straight. And both plan HRAs are going to have unspent funds, and they revert back to the employer. So the other question is, am I allowed to change my spend down to the new dental vision HRA along with my other HRA you're going to administer for me in 2014. The two HRAs, can I make them all the same dental vision? Please. The tax code for the 105 for HRAs allows you the spend down period to impose any combination of restrictions, meaning you can change the plan. So the tax code allows you to change your current 24-month spend down HRA to a limited scope dental vision HRA. New regulations mandate a waiver form for 2013, meaning the medical plan that's in place right now, and if your employees are in the exchange, we got to get them to the website right away. They have to sign a waiver form if they're receiving surplus tax credits. So the waiver form is available for the medical HRA, not needed for dental vision, medical, the current 24-month rundown that you have. That waiver form is available. All HCSO HRAs should convert to a dental vision HRA March 1st of 2014. And let's talk about that a bit, because employer benefits of one plan for the dental vision HRA. My team sat around, we talked about this. We want to make sure that you understand, by going to one dental vision HRA, it helps employees to be eligible for that insurance exchange. That's how we make that happen. It's going to save employers money, since the dental vision HRA is more of a limited scope. Employer doesn't have to administer a waiver form. Once we get through January and February, you won't need to have a waiver form. It'll be available, but you won't need it because the dental vision doesn't need it for the next 24 months. Administration is easier. Employers only send one file to Beneflex for all its employees. You don't have to track them by the plan they're in. It's easier for employers to explain, since all employees have the same dental vision HRA plan. And there's less complaints, as employees have frustrations because they have two plans with Beneflex. You know, for an example, one HRA fund runs out and the other limited HRA plan starts with different benefits. Employees submit claims, they've spent money, they're denied. Let's get them all to one plan. Let's communicate it now, and let's have it happen uniformly so it's easier for everybody. Because on the employees, by having that dental vision HRA, it automatically helps employees to be eligible for the insurance exchange. It's automatic. They don't have to fill out a waiver form. They don't have to go to our website. They don't have to turn it into you. You don't have to submit it to us so we know what's going on. It's easier for the employees to understand, since all employees have the same dental vision HRA. It minimizes frustration, as if you kept two plans, funds expire, they go from one HRA to another HRA, they've made expenses that aren't reimbursable, they're upset. So the next step for those who sign up for the new dental vision HRA for 24 months and new 2014 HRA accepted benefits. On January 15th, you're sending me your fourth quarter hours. Let's also send in the dental vision HRA order form that's available on our website. By January 30th of 2014, Beneflex is going to send out your summary of material modifications along with the required annual SBC and your quarterly statements. Well, with that SMM, we can put the new rates for 2014 in there so employees know how their hours are being calculated for the new dental vision HRA. We can put an explanation of the new dental vision HRA benefits. We can put in there the new hours to qualify for the dental vision HRA, or 8 to 20. We'll explain that to them. And the SMM will cover employee waiver rights. Until we switch your dental vision HRA, which is an accepted benefit, those waivers can be found on our website. Click on Services, go to San Francisco HCSO HRA. All your resources are listed there. waiver form is listed at the top. They can take care of January and February, and in March it's no longer going to be needed. Next step for those who just do the new dental vision HRA 24-month spend down. That means you're not going to have us do your average 8 to 20-hour employees. All you want us to do is a 24-month. You might be using the city, you might be using Boone. You're still going to send me your fourth quarter rewards on January 15th. By January 30th, I'm also still going to send out a summary of material modification for your plan with the required annual SBC and the quarterly statement. The SMM was going to cover explanation of the new dental vision HRA during spend down, that new benefit, the outline of the 24-month spend down and final claim deadline that I already shared with you, and the SMM will cover employee waiver rights. Again, they have to have waiver rights during January and February until we switch all of your plans to the dental vision HRA March 1, 2014. So, the dental vision HRA order form. You can find it at our website. Must be returned by January 15th. And your HCSO options. I wanted to make sure that I covered these because there's a lot of material here, and I apologize for it, but I'd be remiss if I didn't put all the soup in the kettle. So your HCSO options, Beneflex can do your dental vision HRA for the employees that are 8 to 20. And you can use the Boone group for all your employees that have hours 21 to 40. You can make that split up. Give Boone all the hour employees over and give Beneflex the dental vision HRA to save the money. The second option, you can do Beneflex's dental vision HRA, everyone, all employees 8 to 20, and then anyone who's over, you just send the city the 21 to 40 hours. So the city's basically going to get 20 hours and Beneflex will get 20 hours, and you'll be able to save the HRA funds. You can just go with the city plan if you want. That's 100%. You're all in and you're all done. You give them the same quarterly reporting. You do the same report at the end of the year. And the medical plan is for all 213D expenses. And finally, you can do insurance or you can do the Boone group. So you've got 4 options out there. Beneflex is very happy to discuss any of these, and there is some good news. Beneflex is going to offer the SMMs in English and Spanish like we always have done. And many of you have already given us your preferences, so we will automatically deliver those in the language that you prefer to the employees that you want to receive this specific language. Beneflex is currently in the process of creating educational pieces on the dental vision HRA in English and Spanish. Those are going to go out. These documents are going to be with the fourth quarter statements, announcing a March 1, 2014 start date for the dental vision HRA. If you need more time, more good news. The city says you have until April 1 to add the new dental vision HRA for employees who work an average of 8 to 20 hours a week. That's because this is a quarterly benefit. We can work with you. If you can't decide, we still have to get your quarterly statements out for your 24-month rundown. But we can take care of that dental vision HRA at a later date. We just would like to do it all at once if we could. Just makes things tidier and neater. It's just a tight deadline. And if you're considering the Boone Group insurance plan for employees who work an average of 21 to 40 hours a week, they have also extended their deadline through the end of February. You have until the end of February to submit that. Transamerica has said they can backdate those plans till January 1. So if you need more information there, contact us. We can hook you up with Brad, or if your broker's doing this, have them contact us. Now's the time when we're going to take some questions from the audience. We want you to submit the questions via the text message box, Any questions that we don't get to, because we had a lot yesterday, and I assume we'll have a lot again today, will be addressed afterwards. The questions and answer documents are going to be posted with the recording of this webinar at the website you see on this screen. So let's you type in those questions, and while you are typing in those questions, we're going to also put up there the contact information for Brenda and ourselves, our 800 number, or if you want to submit the questions by email, that's fine. This is our second presentation, so everything from the first and second will be posted at the website. I do want to point out that I hope you noticed our 20th anniversary logo in the bottom corner of all of the slides. We're very excited about our 20th anniversary, and I want to take this time while you're typing in your questions to thank you, because Beneflex doesn't exist without our clients. So it's you out there that is the reason for our being, and we want to thank you for your business. We greatly appreciate the input you give us. We greatly appreciate you letting us take care of your benefits for your employees. And we hope you find these educational webinars helpful, because we're trying to add value wherever we can. So having said that, we do have some questions that are coming in, and Brenda and I are going to go through these. And the first question has to do with the waiver. In fact, the first two questions have to do with waivers. The second one's brutally honest. The waiver option is not clear. Please explain. And the other one says, so they're waiving their rights to keep the spend down, I'm sorry, to keep their tax credits. Does that mean the spend down goes away if we convert them to dental vision? So there's a couple questions there, so let me repeat, hopefully with more clarity, how the waiver is going to work. You have a 24-month rundown, and for the employees to be eligible for California exchange tax credit, they cannot have another medical plan, and the 24-month HRA is another medical plan because it's a 213B plan. That's why we need to move all of you to the dental vision accepted benefits, because accepted benefits are allowed, and that means your employees can go to the California exchange and get the tax credit if they qualify. So for in January and February, the employee signs the waiver allowing them to get the tax credit on the California exchange. We move you to a dental vision HRA, meaning anybody can go to the exchange. No waivers are no longer needed. It's nice and clean, and their own employees and you are only dealing with one HRA. Brenda, do you have another question?
Yeah, we have a question here asking, can we please review the steps we need to take to complete the transfer of our current plans to the limited dental vision HRA benefit? And what we do is we start by completing the form. You'd want to send it back to us once it's completed to info@beneflexhr.com. Beneflex will then start the process of getting your plan switched to be an accepted benefit. First, we're going to update our system, and then we'll send you a new FMM. We will then include any updated verbiage on the quarterly account statements. We're then going to be able to provide your customer service to your employees pertaining to the change.
So, thank you, Brenda. There's a couple other questions, again, I do apologize. There's so much information. I had these same type of questions yesterday, so I'm happy to speak specifically to these questions. Is this option, in addition to the option to have an integrated HRA with either the employers or another group health plan in order to be compliant with the ACA? So let's touch on that. You can have an integrated HRA with the employer's medical plan. That's the HRA that's tied to the employer's insurance plan, and that allows you to reimburse medical expenses. You cannot have an HRA tied to an employee's spouse's medical plan. So the reason that you would do, let's say you have employees that have insurance, but it doesn't meet the minimum spending requirement. You can put a medical HRA plan with that and be in compliance with the guidelines. And since they have the employee's insurance, they're not going to go to the exchange anyway. So if your employees have insurance, they don't meet that does not meet the minimum spend requirement, you can put a regular medical HRA with that. This whole talk has been about the accepted benefit HRA. And there's a question, the next question talks to, does the existing HRA meet minimum essential coverage? No. The HRAs do not meet minimum essential coverage. Do they affect the employee's ability to get the tax credit? The accepted benefit dental and vision HRA does not prevent the employee from getting the tax credit. Is there a method for employees to forfeit their HRAs? Well, and that is the waiver that we've talked about. January and February, until I switch everybody over to the dental vision HRA, the employees have to sign a waiver to get that tax credit. Effective in March and for the rest of the 24-month rundown, and for all of the new HRAs that are doing the limited dental vision average 8 to 24 hours per week, those do not require the waiver. The rundown HRA funds cannot be used past 3/31/2014 for anything other than dental and vision, correct? And that is correct. The limited dental vision HRA is going to be put into effect on March 1st. And we are stopping any other, it's March 1st that the HRA funds cannot be used other than for dental and vision. We're getting that notice out by the end of this month. That'll give them a solid 30 days to turn in any expenses they've incurred. And then starting March 1st, it will be dental and vision. Can you provide, let's see, is the dental vision HRA only for employees who work an average of 8 to 20 hours a week? That is correct. Going forward, you can only put in that block of hours, and you're going to have to do something with the other block of hours. And I went ahead and I ran the numbers yesterday after that question had come in about how much money we were talking about. Because if you're a large company, the employees are earning $2.44 an hour. And so the best case, or the smallest amount you would turn in is 8 hours a week times 13 weeks. So that's $253. And you've got that 4 times a year. So you're looking at approximately $1,000. In an HRA, if you have usage of 20%, and I'm using easy numbers for my math because, you know, that math is not my thing. My brother's the accountant. But if you have $1,000 and there's only 20% usage, that's an $800 return on the dental vision HRA. So that, you know, it's going to fall right in line with the same type of savings you've been seeing with your existing HRA. If you have the employee that's at the top of the scale earning 20 hours a week at $2.44 an hour for 13 weeks, that's $630. I'm sorry, $630. If you take 600 times 4, that's $2,400. Take that at 20% usage, that's quite a bit of money again the employer stands to save versus the city option, which keeps it at 100%. Now, if the city option's right for you, it's your decision to make. But, you know, please consider this. And the next question kind of leads into this little spin-off that I'm on here, and I'm going to combine the next two questions. It says, we've already signed up for the city option, or what if we want to do the Boone Group insurance option? You can still do those if you want to do them. If you've already signed up for the city, you have until April 1st to change and get into the dental vision HRA for your 8 to 20 average hours a week. If you've signed up for the Boone Group, and again, full disclosure, I'm not an insurance agent, so I'm just repeating what I heard on the presentation we did. The Boone Group plan is a month-by-month plan. And this first year, like I said, the city gives you till April 1st. So you've got some time to move around and explore, make calls, make discussions. And please contact the Boone Group, contact your broker. Ask us if you have questions and you want to need clarification, because we want to help you because we value your business. Let's see, do I have any more questions? Is this a repeat? It's hard to read the questions and do the answers at the same time. So if I have an employee on medical insurance, but the insurance amount is less than the mandatory contribution amount, can I have a medical HRA of Beneflex to contribute an additional amount to meet the mandatory contribution amount? Yes. You can make up the difference with the HRA. And the last question, I think I just talked about this too, but I'll read it just to clarify it. How do you calculate the hours per week? Our employees vary a lot of hours, so the employees can keep switching between 20 to 25 hours to 15. How often do I calculate this and on what basis? It's a quarterly plan. The city says you use 13 weeks per quarter. Take 13 weeks, divide it by 13, and come up with your average. Now, if you're going to try and take employees that are bouncing between 20 and 20 or more, you know, you can do that and just switch them from plan to plan if you use us in the city. The Boone Group, they're going to say, markets all the employees that are 20 and less. We get all the hours 21 to 40. So that's how the Boone Group has said that would work for them. And that looks like that's the final question. So again, please contact us. Our information is up there. We want to thank you for taking the time. We know you're really busy this time of year. With the city giving us information at the 12th hour, it makes it even more difficult. But we'll do and want to do whatever we can to help you. We appreciate your business and want to wish you a good day. Thanks for listening. Goodbye.